Good evening, everyone, and welcome to Admiral Markets webinar of 28 August 2014. We have experienced some technical difficulties today, both me and Chris, so I apologize for that, but that was obviously not fault. That wasn't our fault. I think that the internet has been experiencing some problems in related to various websites, so I apologize for that. Sorry. If it happens again, we will obviously need to restart. So I hope that it won't happen. So today we're going to talk about how to create your own strategy and things which you could always implement into a good trading method. Also, which things you can do and which things you can and you should avoid. Before we begin, as always, standard risk disclaimer. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration the information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk disclaimer, you're also proceeding further with us. And Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author, me and Chris, and in no way it represents the actual suggestion for a trade. These are not MUK's opinions, and the website in the video is not the .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only. This webinar is for informational and educational purposes only. So, today, about how to create your own system. Understanding trade possibilities, indicators which you need to combine, and testing. So, first of all, when you want to trade and when you want to make trading system, you need to decide between whether you will trade trend or maybe counter trend, breakout, or maybe scalping. So it differs a lot because trend trading is a lot different from counter trend trading, and it's also different from breakout and scalping. So you need to know whether you will trade all of them or maybe just one of them. Most of those systems which you can find over the internet and which you maybe trade usually are trend following systems. But Forex market is full of opportunities. So maybe you're interested in creating counter trend or maybe breakout or maybe scalping. Because of that, you need to decide whether you will trade intra-week or intraday. Time frame is very important because the first thing you need to decide also when you create your system is whether you will trade intra-week or intraday. Are you a day trader or maybe a swing trader? Do you maybe like looking at charts every day, every hour, every minute, every week, every month? How long do you want to hold on to your position? Those questions and answers will help you to determine which time frame you will usually use to trade. So probably you will still be looking at multiple time frames, but you need to decide what will be the main time frame you will use when looking for a trade signal. You might maybe use 4 hours to determine trend, 1 hour to confirm the trend, and 15 minutes for entry. So actually, you will be trading multiple time frames. Or maybe you will trade top of the hour candles, so you will look for a signal each hour. You need to know, which time frame you will trade. It's not the same trading intraday and trading intra-week. Intra-week trading is usually all about swing trading, while intraday trading is about trend, counter trend, setups, breakouts, and most of all scalping. So after that, we will talk, of course, about indicators, which will help you to trade. But the thing is, you also need, before you begin with indicators, you need to define your risk. So when developing your trading system, it's very important that you define how much you're willing to lose on each trade. That is very important because, you know, we always talk about it. You need to define how much you're willing to lose. Not many people like to talk about losing, but that is the fact which you need to accept. A good trader will always think about what he or she could potentially lose before thinking about how much he or she could win. So we talked many times about that before. So you need to define the risk. You need to be willing to lose. Only that you will be able to gain. The amount you are willing to lose will be different than everyone else. So you will have to decide how much room is enough to give your trade some breathing space, but also at the same time not risk too much on one trade. So you will learn more about money management as your trading career goes by, or you will of course visit mine and Chris webinars about money management, which will speed up your progress. Money management is a key role in how much you will and should risk in a single trade. After that, then you need to define stops. This is, guys, essentially the same as making a business plan. Because, you know, if you do other business than Forex trading, you probably know that each business requires business plans. So basically, by defining all of those things, you're defining your tools which you will use to make money. Okay? So many of you probably think that as soon as all of your indicators match up and give you a signal, you need to enter. Some other people usually like to wait until the close of the candle. So usually when you create a trading system, it will require of you to wait until a candle closes before entering. I personally use a most sophisticated way to trade. It's Camarilla MACD. It's waiting for the price zone and waiting for the price entry. But if you want to create a system, start by doing a candle close. Or if you trade 1 hour time frame, it's called TOTH, top of the hour. So usually all systems which are traded, I don't talk about sophisticated methods. I'm talking about trading systems. All of them use candle close. Most of them use candle close. Some systems do use live candles, but usually system requires candle close, because if you use indicators, and you need to use indicators if you want to trade as a beginner to advanced trader, then afterward you can move to price action. So you usually need to wait for the close of the candle, because indicators may repaint. What that means in nature is, on live trading, let's say that you need to use stochastic cross for your entry, and stochastic indeed is showing you the cross, but still the candle didn't close because you have 15 more minutes till the end of the hour, and maybe the candle will close, confirming also your stochastic close. But the thing is, until candle closes, stochastic may go from this position to this position. And basically, if you enter while the candle was live, you will get a false signal. You will get a false signal. Okay? So that is why you need to wait for the candle close, because many of indicators, I don't talk about stochastic as just about stochastic, but those indicators change. Some repaint, but some of those calculations change. So if you look at your chart, one time your stochastic may look like this, but when the candle closes, your stochastic may look like this. So that is why you usually will wait until the candle close. Also, you will need to define your entries and your exits. One way to trade to calculate your entries is, of course, by using couple of indicators. I say couple intentionally because they will tell you when to enter. when to exit, that's another thing. You will use fixed target price, dynamic target price, or trailing stop. Fixed target price is pivot point calculation. Dynamic dynamic exit or dynamic TP is Bollinger Band or other dynamic pivot point indicator. And trailing stop is trailing your stop until you're stopped out in profit. So usually those trading styles will differ. Some people choose support and resistance levels as their targets. Other people choose to go for fixed amount of pips. I don't recommend that. Other people use dynamic support or resistance level. So the thing is, however you decide to calculate your target, you need to make sure to stick with it. So never exit too early unless you're using trailing stop and you are basically trail stopped. Good system will always need some form of indicators. Whether that indicator is a price action itself, or maybe that indicator is standard indicator which is integrated on MT4. So you usually need to decide whether you will use standard indicators or maybe custom indicators. But the thing is, all of those custom indicators are based on standard indicators. So when I talk about classification of indicators, I will usually use those standard indicators which are used and which can be found on MT4 by default. Okay, and as I say, many of those so-called custom indicators have been derived from standard indicators, and they just renamed for marketing purposes. Using them effectively is the third part which you need to know, and how to use it effectively I will show you. So indicators are basically something that will tell us something. Forex indicator is a mirror of price action. It is also a mathematical calculation based on a price. It's also statistic which is used to measure current conditions and well as to forecast financial or economic trends. So those are definitions of Forex indicators. The main purpose of using indicator is to define a trend, to confirm a trend and entry, and to place stop loss and target price. Okay? So that is the main purpose of using indicators. Classification of indicators. You have leading indicators, which are called oscillators. We have CCI, and usually leading indicators are entry indicators. Indicators which give us entry points, entry orders. CCI is a leading indicator, is also oscillator, but it also serves as entry indicator. RSI is leading indicator. Stochastics is leading, and it's also an entry indicator. And that is why I'm saying stochastic cross can differ until candle close. If stochastic is below 20, and let's say price is going up, stochastic is already closed. You enter on a live candle, and what can happen when candle closes? If it closes below the opening price, your stochastics will go below again. So and you are in the entry, you're in the trade. So leading indicators are best used on candle close. We also have QQE, qualitative quantitative indicator, which will basically give you also good entry points. There were some good systems back in days, I remember, which used QQE for entry. Lagging indicators are called momentum indicators, and contrary to leading indicators, they basically serve to capture the trend. Capturing the trend is usually done by momentum indicators. Okay. MACD is a lagging indicator which captures the trend after the trend has been confirmed. So that is MACD. But MACD on some settings can also be used as entry indicator. You know that my range bar trading strategy which I developed, and I have presented you Forex range bar professional, I used MACD as entry indicator because on lower time frames and on range bars, MACD can really serve as good entry indicator. A question? Yeah, I see a few questions now. Darshan is, yeah, he's saying prompt start. Yeah, thank you, Darshan. We had some difficulties. And what are 2 files on the email reminder from AM? I don't know. What about ADX DMI? Well, ADX basically can be used also as a leading indicator. But the thing is, on different settings, ADX can also be a lagging indicator. I personally, I know some systems, and I've been presenting you some systems which use ADX. So depending on ADX settings, that indicator can be used for either trend confirmation or entry point. Usually ADX is used as lagging indicator to actually confirm whether there is trend or there is no trend. Usually trend confirmation indicators are lagging indicators. I say usually. That is the case 80% of the cases. So leading indicators usually are entry indicators or indicators which signal you current price action. Okay, I will explain it like this, very simply. Leading indicators are entry indicators giving you entries, entry signals, when to enter a trade. An actual entry signal is signaled by a leading indicator. But a leading indicator also can give you an immediate trend direction. So imagine that you have MACD, which uses lagging setting to give you a trend which has already been established. Then you have a couple of moving averages which signal you current trend, and then you make an entry. That is the example for combination of lagging, leading, and entry indicators. So you have 2 leading indicators, one which serves as immediate trend and one which serves an entry. And the third indicator is basically momentum indicator, which has already captured the trend. Okay? MACD RSI can be used also as trend capture, but more than RSI, momentum, then ROC, rate of change, on balance volume, OBV, those are basically lagging indicators which usually give you the trend strength. ADX also, but most of those indicators, MACD is most prominent. For me, MACD is the best indicator for momentum and for trend capturing. When I see MACD, I already explained about momentum. When I look at MACD, I know immediately what the trend strength is on that particular time frame. So MACD serves in multiple systems. It can serve as great trend capturing indicator. Then we have dynamic support resistance level indicators. Those are simple SMA, exponential EMA, smooth EMA, linear regress moving average or LMA, Bollinger Bands, envelopes, Fibonacci bands. So those indicators are dynamic support and resistance indicators. Then we have static support and resistance levels indicators. Fibonacci points, Camarilla, Woody pivot points, standard pivot points, DMARC pivot points. Then we have hybrids, dynamic and static indicators. Those are Marimet. Okay? Marimet changes its octaves when they're broken, so basically there is a hybrid of dynamic and static. It's more static, but since octaves change, it's also a sort of dynamic. So remember, leading indicators, entry indicators, lagging indicators, trend capturing indicators, dynamic support resistance indicators, and static support resistance indicators, and hybrid, which is combination of both. Fibonacci retracement tool is always a useful indicator. It's always good to use if you know how to use it, and it actually can help you in multiple of trading systems and trading methods. So, in my opinion, when you create a system, you need this. Okay, this is what you need. One leading indicator, one lagging indicator, and one support and resistance indicator. Okay? For entries, we use either Fibonacci retracement or a well-known entry indicator such as CCI, stochastic, or MACD. Okay? So only this. You don't need to cluster your chart with indicators because your chart will become messy. It's not good. So only one leading, one lagging, and one support resistance indicator. We use lagging indicator to confirm the trend. We use leading indicator to confirm an entry or to confirm an immediate trend depending on settings. Okay? Either an entry or immediate trend, current trend. Lagging indicator are higher time frame trend which has already been established. It's good. We use entry indicator to pinpoint an entry, and we use either dynamic or static support resistance level indicator. You don't need two lagging, two leading, two support resistance indicators. That's stupid, guys. Why? Because the thing is, most successful indicator of them will give you it will first give you the entry. The thing is, if you use two leading, three lagging, or I don't know, two lagging, two leading, they can create a conflict between themselves and can filter you too many good trades. So you don't need filters, believe me. Only one leading, one lagging, one support resistance indicator. Okay? Now, this is the system which I have used, which I have created, and I've been presenting you this method. You can also download from my site. You can also download this system. Basically, it's free. It's Forex Professional Range Bar Scalping Method, FRB Pro. You can download it freely, and I have created it basically using those concepts, and it works really. I used this for scalping before the inception of Camarilla MACD, but this is purely scalping method. It uses range bars, and it uses a couple of those confirmed indicators. So two MAs, which are basically giving me the trend direction, immediate trend direction. Then I have entry indicator, MACD, on these settings to confirm the entry, and one static support and resistance indicator, which gives me basically targets. And this system made me money back in time. But back in time, I was scalping most of the time, and mostly I've been using it on euro dollar. But indeed, it has given me great results. Great results, okay? Yeah, a website is www.elitecurrency.com. Okay? So you can download it freely, and you will see it's simple enough. It has a couple of add-ons to this. You can also use breakout trades. You can also use scalp swings. But the thing is, it's pretty simple, but it's effective. It's free for you, and I don't tell you that because I want you to visit my website. No, the thing is, I was the creator of this, and the thing is, it uses a MACD, which I really love. I really love MACD as an entry indicator. So the concepts behind which I was creating that range bar strategy are this: one leading, one lagging, one support resistance. So one leading, I don't use lagging because it's based on range bars. Range bars do not use time frames. This was just for showcase purposes. This system is used on range bars, okay? So I didn't use lagging indicator. So only one leading, entry indicator, and static support resistant indicator. If that system used candlestick instead of range bars, then I would also need one lagging indicator. And I would use probably MACD on different settings. This is the example of successful system. Really, it made me money. So yeah, this indicator is hourly pivot points. And hourly pivot points indicator was available to you if you visited our premium webinar about hourly pivot point indicator. So this is hourly pivot point indicator. Setting for MACD, it's 8.16.5, but this is not the main subject here. I'm just showing you. You can download it freely from the site, but setting is 8.16.5. You have full manual there and full PDF form, so you can read it. But this system I used as an example of a good trading system. Only couple of indicators. Now, what you should avoid when creating system. Do not cluster your chart with indicators, guys. Do not. It will give you too many filters. You will miss out trades and those filters will collide. You will experience analysis paralysis. You will be confused. You will not know what to trade, what the trend is. Why did you make your entry? You would just follow the system randomly like a robot. And it will give you messy charts. You cannot. I hate when I see chart which is clustered by indicators. That is not forex trading. That is, I don't know how to call it. Money can be made without clustering in those indicators. This is the example of indicator which is clustered, and there are many systems which look similar to this. This is stupid. This is nonsense. This thing cannot give you money in the long run. Too many indicators. 1, 2 support, dynamic support and resistance indicators. And this is also Ichimoku here. Then we have 1 leading and 2 lagging indicators. And besides all of that, you cannot clearly define support and resistance levels here. Because we have envelopes, we have Ichimoku, we don't have any static pivot points, so we don't actually know where the price will go. It will confuse us. And this is the example of a messy chart. It's almost impossible to make trend lines from these kind of things. And it's on white background. Imagine what would be if it were on a black background. So guys, these are things which you need in order to define a good system. 1 leading, 1 lagging, 1 support resistance indicator. So we use lagging to confirm the trend, we use leading to confirm an entry or immediate trend depending on settings, and we use entry indicator to pinpoint an entry. Dynamic or static support level for target price and stop losses. This isn't just Ichimoku chart. This is envelopes which have been also put above Ichimoku, but this is also stochastic, this is also momentum and MACD. Why do you need this? Yeah, elitecurrency.com is a site with free range bar strategy. Very simple and effective. Free. So after you have made your system, you will need to test it on demo account. Now also remember this, test all forex pair or pairs which you are most comfortable with. Okay? So you don't just test euro dollar, test all forex pairs. Test various indicators properties. So you can see which setting on that indicator can give you slightly better entries than original. Then test it manually. Don't go with back testing. You need to test it manually. That means 3 months for testing. Live market. So open demo account as if you would trade live account. Same. And test it same as you were trading on live account. So then you will get a feel of the system, and usually in first 15 days you will see whether it works or it maybe needs some adjustments. So because we have 25 more minutes, I will hand over the presentation to Chris, and he will also guide you how to create your own trading strategy. So Chris, you can proceed. Thank you, guys. If you have any questions, you can, of course, ask.
Great, thank you so much. I'll quickly switch and make myself the presenter here. Alrighty, good. How to create an own Forex strategy. Always quite useful, isn't it? I mean, obviously, we don't have to necessarily focus on one. It could be always quite useful to branch out and spread a bit of the risk on strategies. Being dependent maybe on one method, it could be limit your trading and performance maybe. So there are some advantages of maybe trading a second, even a third. It all depends, of course, on your level of experience, how successful you've been with your first strategy, because you don't want to branch out too fast because that could only lead, indeed, as Ned said, to paralysis of analysis, maybe confusion. So preferably, I would say focus on one. Learn that one inside out, and when you get the hang of things, you can maybe start thinking about a second, for instance. And it depends on also experience, obviously. More experience, the easier it is to handle. And it depends on also how automated a strategy is, because obviously if you have it more automated or less automated, the more automation there is in that strategy, the more time there's free to trade maybe a third, let's say, for instance. So these factors play a role. In any case, that set aside, how do you create one? Basically, I'm going to show you here, if I scroll through the beginning, because we don't have to go through that. First of all, the advantages, actually, before I dive into that. Advantages, I already mentioned a few, but among other things, creating consistency is an advantage of building a strategy in general. Avoid overtrading, avoid process of analysis, avoid too much trade management, trade monitoring, and ability to spot trades. Everyone will have their weakness and strength, and depending on yours, of course. But we have various things. For instance, one trader could have more troubles with actually entering. Other traders could have troubles with maybe entering too many times. Strategies, of course, lay groundwork, rules, and guidelines when to do what. Therefore, very useful. So obviously, there's a lot of good reasons for building strategies, and you might think, what is the opposite? I mean, obviously, maybe some of you think it's logical to build a strategy. Not everyone does that, in fact. Some traders choose to do total discretionary trading and don't have any kind of fixed plan. Maybe someone with a lot of experience could do that, but the thing is, strategy has many advantages for people who start out and intermediate and even traders with a lot of experience, because they just give so many advantages on how to tackle the market. So that's why. So that's the reason why creating a strategy is a good thing. Avoiding dangers, the quest of perfect trading strategy, and focusing maybe not enough on non-strategy and analysis. You have to focus enough on non-strategy and analysis elements. I mean, in the sense that only focusing on one part of the strategy, the entry part, will not, of course, be enough. You have to spread a bit of your attention. So these are a bit of the pitfalls that often people bump into. So I want to go through a step-by-step list that I think could be useful for you when you set up a strategy. And then I already explained, what kind of things you can think about. This will show you kind of a step-by-step list, what you might want to check off when making one. Obviously, it's put into a sequence that you could change, by the way. It's sometimes not that black and white. It's kind of like a revolving wheel in a way, where you start here and you bump into things, and it's a creative process in a way also. So obviously you're going to maybe skip some steps, go back a few steps, redo a step. It's not that straightforward, but these steps I would recommend to think about at least. Point one is knowing yourself. I think it's important to know what kind of strategy would suit your psychology and how you look at the market, how you think the trading would be pleasant for you, and also see if that's true in real life what kind of time limitations, just practical reasons you might bump into, like time limitations and stuff like that. Practical stuff like that you want to think of, your knowledge and experience, so you have kind of the parameters of which you can think about. Now this might sound vague, I know. It probably will be something useful to use after you've gone through a few steps to go back and say, okay, does it match what I'm looking for? But writing down some strengths and weaknesses from the very start, I think couldn't hurt. Knowing where you would like to focus on before you focus on something, I think could be good, and then going back to it after you've set up something, okay? Other things. Sorry about that. This is still connected to step one. What I mean, so basically, knowing yourself, what you could do, a practical way of doing that is making a SWOT. A SWOT is an abbreviation for strength, S, the W for weakness, O of opportunity, and T of threats. Strength and weaknesses, you're looking at yourself. Opportunity, threats, you're looking at something that could impact you, but you don't have really an influence on it. Your strength could be, I'm great in patience. Weakness, maybe you're too patient, or I don't know, I'm making it up now at the moment. Opportunity could be, you got tons of time. Threat, I don't know, you expect some big bill coming up. You name it, it's up for you to make it, but that's a model that you can do to get an idea about your situation. And you can combine the S and W with the O and T, and you can make some strategies, actually. I know that sounds pretty far-fetched maybe at the moment for some of you, unless you know this concept, but you can basically say, okay, I'm good in patience, I got a lot of time, so I will focus on a swing trade, for instance. Swing strategy. That could be a strategy. Let's see, the weakness, I'm not sure what I mean. Oh, these are examples. Weakness, for instance, nervous and trade is getting close to stop loss. A threat, too little time. An example of that, if you have too little time, could be don't use true stop losses, for instance. That could be a way how you can focus on setting up your strategy. Then the second point that you might want to think about is trading style. Well, I've already mentioned it already in a different way, scalping, breakout, or trending. But you can also look at it from a time frame perspective, for instance. But you can do both, obviously. What do you want to focus on? What elements would you like to include? Obviously, it doesn't have to be right away 100% decision. You can narrow it down at least to intraday or interweek or interweek, for instance. Then you might want to think about what type of trading you do. I mean, for us, Nenad and I, we're focused on technicals, but still, some might choose a mix, for instance. Then you might want to think about discretionary element. Are you comfortable with trading discretionary, or do you want to make it more automated? You have a wide range of mixes, of course, how you can approach trading, all the way from fully automated to a majority of discretionary trading, and anything in between. Having an idea what could suit you and what you have within your capabilities, of course. Obviously, if you have programming skills, that could be a strength in your SWOT, in your SWOT analysis. And with that, of course, you can make a strategy that does have maybe some automation in it, for instance. So, but just something to think about. Choosing the time frames is a good point. Will you do multiple time frame analysis? Are you sticking to single time frame analysis? If you do multiple time frame analysis, how many time frames? I think 3 are good. 1 for trend, 1 for filters, 1 for entry. The trend is the main time frame. 1 higher could be the filter. For instance, the trend could be the 4-hour. The filter could be your daily chart, and the entry could be an hourly chart, for instance. Obviously, it's just an example, but I like that particular style. And it all depends, of course, what time you have available for trading. Then looking at your strategy model. This is the most important part, probably, where you look at how you define a trend, how do you define the opportunity, when do you get interested, is the trigger, and then a filter is basically what things could make you not want to trade it. So although like the trend, the opportunity are things you're looking for elements in your strategy that make you say, okay, this is interesting to trade, and filter is the opposite. What might not make you trade? What things are undesirable at certain spots? And then the trigger is where, for instance, price really gets into your zone. So to give an example, if you're you want to trade a trending style, so you're looking for a trend. Your dollar has a downtrend, so you're interested. The opportunity might be, for instance, the AO back to the zero line. The filter could be, I don't know, a weekly look for trend lines, for instance, that are too close by. The trigger could then be when the AO is back to the zero line, the trigger could be look for price to go through a bottom in that downtrend. That's it. Now, that's basically you haven't entered yet, but this is how you can analyze whether you're close to entering. Tools and indicators, Nenad mentioned a very nice summary, I think, of various tools and indicators that we want to, we can use to determine trading and how we trade. These tools and indicators we can use to determine how we determine the trend, how do we determine the opportunity, how do we determine the filter and trigger. Trend, for instance, you might want to use moving averages or trend channels. For opportunity, you could use the oscillator, as I said. Filters, you can use trend lines or tops and bottoms. Trigger, you can use candlestick patterns. Of course, that are examples, but you can use these tools and indicators to help you determine step 6. Then we, of course, go to the juicy part, and that is the entry and exit. After you've gone through step 6, where we go through that module and say, okay, these steps, trend, filter, trigger, opportunity, how do we really enter? How do we really take that trade? It could be various ways. We could take the break, we could take the bounce, we can take a confirmation, we can take an early entry. So, for instance, a confirmation could be a price action candlestick pattern, a pin bar. A bounce could be price reaches a trend line and you see price bouncing off that trend line. Now, how do you trade that? It could be a direct entry at the trend line, but you can also wait for not at the trend line, but you can wait for price to hit the trend line, and then on the lower time frame, break in a way to the opposite side. Let me give you an example here because that could be a bit complicated. Support trend line price moving back to the trend line. So instead of taking it at the trend line, market order right there, you kind of wait, zoom into the time frame, you see price hits the trend line, and then you kind of wait for price to start bouncing up, and on a lower time frame, break through some mini top or something. Then you got a kind of a confirmation as well, right? A confirmation of a bounce in a way. Exit methods, various things, could be volatility related, like ATR related, could be fixed TP, could be trade management, like moving your trail stop loss, for instance, etc. These are, of course, the methods. Now, obviously, this is very broad, just trying to give you the parameters that you want to think about. We have a webinar, for instance, as far as I remember, on trade management. So if you want to look at, no, I'm not sure about that, actually, but we might have one soon. Let me check that. I think we have one next week. Anyway, in the meantime, I'll check that. Other things you want to think about are management, logically, risk, money management. Logical, of course, the things that you want to think about when discussing a strategy. And this is a pretty long list, but refinement of the strategy. Testing in a way, you don't want to maybe get too much involved in the optimization process because that could be almost self-defeating, but testing obviously very important. Maybe taking a specific period of time and testing your strategy on that, then taking those parameters and testing it on a total different pair, a total different time frame, not time frame necessarily, I mean time period. Let's say you tested 2014 and you go back to 2011 and test it on that. This is, of course, obviously you can do with your strategy. You can paper trade it, you can demo trade it. This is going to need a lot of patience and discipline to do all that. Recommend having adaptation and realistic expectations of your strategy. You want to evaluate it and give feedback on it and compile stats, of course, so that we have more info on the performance and what we can expect regarding drawdown, regarding other stats, of course, like win percentage and R2Rs and etc. So refinement, very important process, of course, the kind of like the cement in a way. You start out with a vision, and obviously that path is going to have some ups and downs. It's going to have some loops, basically, where you go back to your starting point or where you make refinements. And then after that work, then a last kind of checks are being made, and you're pretty certain that the strategy has a decent robustness. But obviously, you're getting a bit excited about it, but obviously you still want to double and triple check and make sure that everything is well pieced together, and that will require a bit of patience, and then slowly but surely maybe start to trade it very seriously on a demo, or maybe with very small trinkles of real capital eventually, of course, logically, but have to take your time. Don't jump the gun. Then we got the strategy portfolio, as I already said at the very beginning, actually, that you can then, when this process is successful, you could repeat it or mix it with strategies of traders you know, friends you know, or join our webinar, join Nenet's webinar and my life trading webinars, and see what points you might want to use from us, our trading, for instance, or etc. And you can make a strategy portfolio, things you've created, things that we've used, or a mix of that, obviously, all built on how you want to tackle the market and what suits your personality, schedule, and goals and risk levels. Advantage of that is that you reduce the risk and spread the risk if you have multiple strategies. Big advantage. Obviously, you're not dependent on one particular strategy, so that is a nice advantage, diversity. And I think also a good thing is you're less dependent on your psychology in a way, because one of the things that could happen is, obviously, if you're trading one thing, you're maybe get impacted by its performance. Whereas if you're, let's say, have more eggs in one basket, I know it sounds a bit stupid, but if you have more eggs in one basket, then you're not bummed out. Let's say if one week one strategy doesn't work that well as you expect. You're kind of like more balanced in a way because of that, I think. Now there are disadvantages, and that's why I said you want to be careful with doing multiple or starting a strategy portfolio. I mean, confusion, paralysis of analysis, letting one strategy impact the other strategy. You want to be careful with that and make sure that you keep your strategy parameters separate and you don't mix them up. For instance, one strategy is looking to long the euro dollar, the other strategy is looking to one strategy longs the euro dollar. Eventually, after one day, the other strategy, you're shorting the euro dollar. So, or you're shorting the pound dollar. And because of that, you decide to close your euro dollar, for instance, despite the fact that your strategy doesn't say that you should, but only because your second strategy has a different conflicting view. So that, of course, has its dangers if you, in a way, unless you have rules that say that you have to do that, but you get my point. So you want to make sure that you keep it separate. You, of course, think about your risk management with these multiples, etc. We can even talk about that maybe in a separate time still. I'm giving you an example of a strategy just in case we had some big time left to discuss, but really we only have a couple of minutes, so we won't be able to make that in these few minutes. But for example, you could be thinking, this is an example of strategy. It's a trending strategy. It's a breakout. It's a swing strategy using the 4-hour chart, using technical analysis and little discretion. That could be one set of parameters for the strategy, for instance. Using these tools and indicators, I don't want to go in all the details, but parabolic, Ichimoku, for instance. Using then this model to decide how to enter, what the trend is, what the opportunity is. I'm not going to go in all, the exact details. There was a separate webinar on this. What the filters are, what the trigger is, what the entry method is, what the trade management is. Right. So, an example of how you can tackle that with the points I mentioned. If you want to have those points, that went maybe too fast for you. So, send me an email and I'll send you the list. Okay, if you were interested in that. Or maybe you can always look at the recording, I guess, but for the moment it's taking a bit longer for them to upload. If you have questions, let me know or let us know. Thanks for joining as always. Great to have you here. Don't forget that we have live webinars on Monday, Wednesday evening, and Tuesday, Wednesday, Thursday morning. These are the spreads. Check it out. And the social media stuff, Twitter and Facebook. And got a question. Could you please show the previous slide regarding the Aussie? This slide, statistics. The archive employees on holiday, so that's why we're having a bit of a delay with the uploading there. By the way, this is the live webinar schedule. We got Swing Point Premium webinar with Nenad, by the way, on the 14th of September. If you have a live account, you can sign up and join that webinar in 2 weeks. Next week, we got the recap, as always, on Monday. We got moving average trading, trading intraday on Wednesday, different approaches to breakout trading with Nenad on Wednesday indeed. Thursday, we're going to talk about optimizing your approach to exits for better trading results. So let me know, Darshan, I guess you were talking about these slides maybe regarding the Aussie. Or otherwise I can just send you the PowerPoint, right? No problem. Or I can send you these slides. This particular strategy on the Euro-Odd had about a 50-50 win rate. It had, however, a pretty good, very good actually, R2R ratio. So won only half, but when it won, it really won a lot more than it lost, so that was pretty interesting. But the testing was very limited, so be careful of that. Extra warning that more testing would definitely need to be done. Didn't have many trades, but so all in all, as you can see, it's just a guideline for you to kind of put everything in place and put the pieces of puzzle maybe in a more logical reference framework, so that you know that you've gone through at least the most important things, and you have a clear idea how you want to use your tools and how it all pieces together, I think, so that you have a clear view how you can tackle it and step by step build strategy. Well, I don't see any questions, so I guess we can wrap it up for this week. Thanks all for joining again for today and all of the webinars that you have joined this week, and wish you all good trading tomorrow and a good weekend. See you all soon. Cheers.
See you soon. Cheers.